Hi there. My name is Amber van der Wath. I work in investor relations at the Baobab Network.
Thank you for joining the African Tech Roundup.
Thanks for having me.
Absolutely. And my sense is that Africa is trending towards a relatively more collaborative environment than the greater VC ecosystem globally. Is that just a sense I have, or is that sense based on some sort of reality?
No, I think you'd be, largely correct in saying that. I think there is definitely more space for collaboration than there is for competition, so to speak. I think all founders will say that capital is not flowing through. And so I think, it's up to us investors to really gather together and share, knowledge and insights about what we're seeing and how to also readjust kind of maybe our benchmarks to fit the current tricky funding cycle that's going on at the moment. And what I mean by that is just adjusting the way we support portfolio companies as they try remain lean and cash efficient and capital efficient right now, while still on that kind of growth path and trajectory. As a very early stage, first check investor, I know for us, we're always seeking for feedback from investors at a later stage, because if we can't feed them pipeline, that meets their requirements, then it's a lose-lose for all. So really pushing for a bit more knowledge sharing on those kind of things with regards to due diligence and getting there. But I think that in-person connection and summits like today is still really important, because I think email inboxes are getting crowded.
I wonder how being one of the more visible and perhaps well-known, well-branded VCs in early stage tech investment, how that plays to the power dynamic of Baobab in that conversation. Are you typically facilitating syndication opportunities? Are you leading rounds and then inviting people to the table around you? Are you trying to share your due diligence notes with people who might not otherwise be involved? What does it look like practically?
I mean, you've touched on many points there, so maybe I'll just dive deep into one in particular that I think is quite exciting. Obviously, we all know about kind of the GP-LP structure. We know that angels do direct investments and that there are, syndicates out there to pool capital into a certain startup. But what we've actually started doing at Baobab as of last year is we've created almost a co-investment vehicle that allows investors to invest in a batch of Baobab companies. So not just directly into one, not into all of them, but just into a batch. So we've done this. It makes most sense to do it in the batch that we invest in, for 2024. And what's really cool about this product or this vehicle is that investors, especially international investors who don't have enough time, capacity, or confidence to do direct investments, or do not have a big enough ticket to lock away their capital for like a 7-year fund, are able to now enter the ecosystem with a bit more low touch, a little bit more seamlessly into kind of this batch that allows them to gain market insights into, say, like the 20 Baobab backs this year, with the hopes that out of getting that spread of the 20 we invest in this year, that you come in at 2 now, you'll be able to gain more conviction and confidence going forward. We're hoping that unlocks more capital in the coming years, where the angel who's now in our investment product does a direct investment or does an LP investment. And we just think it's a nice kind of vehicle for those investors that are on the fringe, too scared to make a direct one, also not necessarily wanting to lock away their capital, but this is kind of something like a bit of a sweet spot in the middle.
What's the sweet spot from a ticket size perspective for that profile of investor?
It's $50K essentially. So our minimum ticket size is actually 20. So we're seeing actually a lot of GPs of like European funds investing their own capital in a vehicle like this, with the hopes of getting some market insights, getting a feel, and almost developing a track record and their own thesis as they look to maybe do an emerging market fund in the future. This is kind of a way for them to dabble, so to speak, in the space. It's pretty accessible in that sense. You just need to be a sophisticated investor to participate. You don't have to be an accredited investor.
It occurs to me that you're solving for risk aversion, but you're also solving for a desire to learn and understand what is often perceived as an untenably risky market in the absence of true sort of market knowledge and in-market experience. What are you seeing in terms of people taking to this idea? 1, 2, how do you keep them sufficiently interested in the eventual likelihood of their interest in those companies basically being diluted, obviously?
If it wasn't for something like this, they wouldn't even kind of bother. And in a funding market where, especially in the early stage where you really can't be too sure of anything, you're just really backing the teams. I think being able to have the spread that we get as Baobab, we're now in 16 different markets. So, not heavily concentrated in Nigeria, not heavily concentrated in Kenya.
And that's 60 different, you're
16.
Sorry, but your portfolio is about 60 businesses at this point, right?
Correct. So, for example, for this 2024 Access Fund, we're in Cameroon, Morocco, Ivory Coast, Uganda, Nigeria, and Kenya, of course, still. I think it just gives you more diversification and in places where you maybe wouldn't have otherwise found pipeline. I think with the kind of dream case scenario would be after a year, maybe you as an angel co-investor feel particularly bullish about 2 within that batch, then you'll be confident to double down and do your own, individual tickets. So that's the dream case scenario, essentially.
So this is really a very sophisticated ecosystem education initiative because
an education play in a way, and for sure.
Yeah. So the fundamentals here aren't driving the capitalist intent of a disciplined investor who's trying to optimize for outcomes here. There's enough there to keep that person interested to sort of warrant them not keeping their money in a bank or whatever, or in a property someplace. But there's also the invariable need any investor in this space is going to have to sort of encounter, which is to learn about the market and gain more confidence to do bigger and better deals.
Yeah, for sure. And I think Baobab seeks to be kind of that trusted, layer between the two.
Gateway.
Exactly. Love that word.
I almost said drug, then
same thing, no jokes. But exactly. And, sorry to put on your second point you mentioned earlier, because we're so hands-on with these companies in the first 3 months through our acceleration program, we're creating reporting frameworks that will then quarterly report on behalf of that batch of companies and present it obviously to the various co-investors in that vehicle for that year, kind of keep them engaged in that way. And you can be as passive or as active as you want as an investor too. As I said, either you double down or you kind of just sit on it and wait now and, wait and see. It is, a long wait relatively, as we know, but I think it's, a nice way for people to dip their toes who would otherwise maybe not otherwise.
Interesting. You touch on the horizons aspect. What horizons are folks like Baobab selling would-be investors of any kind at this point on the Africa opportunity or Pan-African sort of VC opportunity?
Talking from an early stage perspective, we come in really early, often the first or second investor on the cap table. And so we see also a lot of liquidity opportunities and exit opportunities as early on as like the Series A round. So I think because of that timeline, we were able to kind of recycle the investment and actually deliver it back to these investors.
In a general horizon sense of things, is this a 7-year journey? Is this to returns, that is, or to some reasonable evidence that your money wasn't better placed in another market, say?
Yeah, I guess as they always say with venture capital investing, like be prepared to lose all your money. It is very high risk, but at the other side of it is very high reward. So using most recent example, we invested in a company last year and then kind of 15 months later had a secondary sale opportunity because of their oversubscribed seed round. And we were able to partially exit from that business. So there's liquidity there and returns. But we've also kept some of our equity in that business so that if they, and we hope they do really succeed, we can, still make the most of that upside. So there's the returns there. And then also because we're so early, we like to invest in also kind of the more emerging regions outside of the big four, big five, so to speak. So we're in Uganda, Tanzania, in Morocco, and we're also keen to invest in these kind of potentially regional winners that are, as I said, get acquired at Series A, etc. But I guess the time will tell. We're still pretty early. As you mentioned, we've got 60 portfolio companies, but the last 30 have been invested in the past 2 years. So so we're just working our hardest to support them as best we can for now and keep finding amazing founders to back.
So I'm curious about founders who have before them perhaps more, and I'm talking about elite founders, the very best, who might not be struggling as much as most to get, the kind of VC backing they hope to land. For those founders, there's perhaps never been more opportunity from more viable options. And so I wonder how, you contrast that dynamic with what you described earlier as perhaps a relatively more collaborative environment than we see in Latin America, with more advanced markets like the US and UK and Europe, and certainly in India. It does seem like if you're a solid prospect, it's probably hard to be Baobab for that person and convince them to come over.
We're often the first investor, which means there's like this first money risk. And so we do ensure, because we kind of back calculated it, that we take sufficient equity upfront to be able to essentially justify the risk that we're taking on, and so that we do lose out on a few founders because that initial equity percentage is quite high. But I think founders who have been with us will speak on our behalf in saying that it comes through at a later stage. As said, we're not impartial to secondary sales, and so that'll kind of prevent further dilution further on. But as you mentioned, for early stage, like first-time founders, we're very keen to invest in them as well, to level the playing field for founders that would otherwise not have access to capital and networks. So we're kind of almost there for the underdog, so to speak, who hasn't been to Harvard or hasn't done their MBA and doesn't kind of know a guy or knows a girl and knows a guy. So yeah, I think there's still a lot of work to be done on our side to make sure we're finding the best founders, but also knowing willingly that, some founders would rather bootstrap and instead of have that dilution incurred by Baobab. And, we wish them all the best and say, please come partner with the rest of our portfolio companies.
Definitely put there.
Thank you. Thank you.
So I have a question about exits and the secondary market. Speak to the skeptic listening to this podcast right now who's not entirely sure. Okay, they might be bought in on what's emerging as a legitimate asset class, VC. But then they're going, the secondary market I keep hearing about, is it a real thing? I mean, what would you point to as, apart from the story you told about this exit you finessed, which is great, congrats. But I mean, is there truly a secondary market to speak of for exit-focused investors who are looking to this asset class for more pragmatic, maybe more immediate, medium-term returns?
Yeah, it's a tricky one. I would say there's probably too soon to tell. And I know people can get quite pessimistic about looking at how many millions of VC funding has come into the continent and maybe not how many, IPOs and exits and things have come as a result of it. But I think relative to globally, it's still a very small amount of VC investing coming our way, and we are still really nascent relative to the rest of the globe. So yeah, too early to say. I would say if you are a bit skeptical and kind of don't really kind of understand the game essentially, then I would say maybe, watch and wait and see, or otherwise explore some of the other alternative financing options that are emerging on the continent, like venture debt. There's great players emerging on the continent like Untapped Global, etc., that looking at also really cool ways to ignite growth and get returns in the early stage. So venture debt's also, I think, quite an exciting maybe space, still risky, of course, but for more traditional investors, maybe feels a bit more robust than VC purely. So yeah, I would say maybe consider those options first and then come chat to us.
Final question is the question of venture debt. It's getting mixed reviews in the market at the moment. A question really being at the earliest stages, especially. And speaking now as an investor who might advise a listening founder contemplating this as part of their investment mix. Should early stage investors be considering venture debt below a certain level of traction and or growth and validation?
It depends on your risk profile and like your risk appetite. But I think personally, I wouldn't want to be in a space where I'm lending to a company and I know that the money they need to service this debt is going to essentially hamper their growth or put them into ruin. It should be an enabler for growth. And so I think you still have to look quite rigorously at the fundamentals and make sure that the debt provided is to enable growth and that those fundamentals are strong. And I think venture debt does have a role to play if cleverly done and packaged, especially, in a market now where VC funding is quite dry and quite slow. Due diligence processes are slower. Investors are sitting on pipeline for longer than they usually do. And I would say VC investing can be driven by signals and FOMO and everything. And I think venture debt in the right manner can kind of just settle that and
force a focus on fundamentals.
Exactly.
Potentially.
Small foundation through their Emerald facility are, beginning with small tickets for debt as low as kind of 50K. And so, hypothetically, in worst case scenario, they don't repay it back 50K is still 50K, but we have people throwing millions into venture capital into just visions and narratives. So it's kind of two sides to the coin there, I guess.
Fantastic. Look, Amber, thank you so much for your time. I appreciate you being on the African Tech Roundup.
Awesome. It's great to be here, and hope to see you again soon, Andile.